Shares in Asia fell as China left its benchmark lending rate unchanged. Hong Kong's Hang Seng index plunged 1.84% with Chinese tech shares largely continuing to see another day of heavy losses as regulatory uncertainty surrounding the sector lingers. Over in China, mainland Chinese stocks were also closed a little bit lower, as you can see on my screen. Lots of red compared to how we were probably a few weeks ago. However, European stocks at this particular point turning lower as the trading session developed amid concerns over monetary policy, the Delta COVID variant, and of course, China's tech crackdown continues to linger. Stock futures in the US are in negative territory right now after a choppy, regular trading session ended with the S&P 500 slightly in the green. To talk to us about the week that was and a lot of the things that we had covered over the week, and to analyze them in depth, we are joined by Warwick Lucas from Galileo Capital. Warwick, thank you so much for your time. Let's check in on the JSE. I mean, how are we faring right now compared to what I've been seeing on my screen a little bit earlier? Some red colors across the board when you look at some of the global markets.
Bit of a cautious Friday there, Natasha. I think we're basically down across the board, but not perhaps as much as we are in Europe and Asia and so on. So I think what's happening there, of course, the rand has been weaker the last couple of days, and since that tends to support our earnings, and after all, we are an export economy, it tends to take a bit of the sting out of it under this particular scenario. So we're weak, but we're looking all right under the circumstances.
So you had Mr. Price releasing its trading update earlier this morning, and I'm curious to know, what's your feeling towards retailers at this particular point?
Okay, so I think retailers are getting some kind of traction there from the post-lockdown recovery. That's been going on. I mean, when you look at those earnings, they actually provide some helpful data in that they compare their turnovers both against last year, which was, of course, in the middle of a very serious lockdown, and then the prior year as well. In the case of Mr. Price, they appear to have grown some market share. And I guess under the circumstances, it's understandable, because they're the kind of retailer that tends to have a value proposition. So they might have done a bit better than the more expensively priced retailers. But I guess the situation where we have low interest rates as well has probably been helping those consumers that can spend to go out and spend on clothing. And I guess that's quite an important effect for the consumer generally across our economy, that the Reserve Bank has at least been providing that relief in line with the fact that our inflation is persistently still quite low.
So there were various themes that played out this week, whether it was Afghanistan, the JSE, starting trade much later than expected, and various other things happening, the dollar reaching a 9-month high. Which of these themes caught your attention, or are there other themes that we may have missed this week?
I think you've basically captured the key ones there. I think the US leaving Afghanistan, it's not before time. I think the war and the involvement there really was a complete waste of time, and frankly, no defeat looks organized ever. So I think the chaos perhaps is more understandable than the news that's coming out in it. And in terms of Naspers and Prosus, well, I guess we saw the JSE stress tested to its limit. It was, after all, the biggest trading day ever on the JSE in terms of value by a factor of more than 2. So I guess from there they're going to have to reinvest in some systems. And of course, the other news of the week, our CPI is looking on track. I don't know whether that perhaps shows an element of growth concerns. After all, I mean, that did relate back to a rather riotous period. And our insurers are also taking a lot of COVID claims at the moment, and that's putting a little bit of pressure on them as well. So it's a newsy and noisy week indeed.
So yesterday you had Wall Street's VIX index, the volatility index, spiking a little bit higher. What can we read into that?
Okay, so I think generally it's a kind of a risk-off period. I mean, what we're seeing here and what's really affected markets in the last week, in the case of the US, it's been a question of, well, is there a taper tantrum? Europe has more been a case of what's happening with COVID, and in China it's more a case of what's happening there in terms of both crackdowns on infotech and the fact that they're running a tight credit environment. It's caused the likes of retail sales to look weak, industrial production has been weak. So generally we've got a slowing Chinese economy. And the US, well, I mean, to slow down their purchases of bonds from $120 billion a month. Well, I mean, that's a huge rate of purchases. So it just shows that certainly that market has been propped up, walking along on crutches, and now it's got to wean itself off those crutches.
All right. Before I let you go, what events will you be paying attention to going into next week?
I'm going to be keeping a very firm eye on that US market and the whole discussions around tapering. It is quite important. It's not necessarily all bad. I mean, after all, we've had some great earnings coming out there as well. But that process of moving from having a broken leg and then starting to shed those crutches, it's a key moment, and I think it's a long expected one. So that's what I'll be watching in the week ahead.
All right, Warwick, thank you so much for your time. That is Warwick Lucas from Galileo Capital.